There goes the S&P down to 33. Eurostoxx, you've got time. It's not reached 88 yet. The S&P is already off the screen, so through 29, through 20. Eurostoxx is now through 88. So your target in Eurostoxx, straight away, you'll now think it should be 55 at a minimum, and then you can start placing your targets further down towards 32 and then 04. We've done some tariff videos earlier on this year, looking at the ones in January and the impact that they had, particularly in currency markets. What we're going to look at now is, what have we learned since then? How did the markets react, or how did markets react to the EU 50% tariffs that we saw on the 23rd of May? What have we learned? Where do you want to trade? So we're going to show some order flow of this. I'm also going to show some of the charts and some of the reactions to these commas. Anything macro, you need to understand speed of assimilation. What does this mean, and how quickly can you then act? So what we had on the 23rd was Trump talking about tariffs on Apple. Now, this, even if you're not trading that, should alert you. He's clearly talking, he's talked about tariffs, and he's also giving you a number, 25% on Apple. Now, this wasn't the big trade. There was some movement on it, and of course, S&P and NASDAQ is the place to be, for obvious reasons. NASDAQ's part of them. The next one was the comment on Europe. And when he comes out with this comment of 50% tariffs on Europe, this is a massive jump from the 10% universal tariffs. This is the trade. So then it comes down to, right, what do you do? What markets do you select on this type of trade? Real key part to any kind of macro trading, quickly deciding what markets. Now, obviously, if this is a Europe tariff, the go-to place is going to be Eurostoxx. So let's go and have a look at what exactly happened across different markets. Now, the first place, whilst I've said Eurostoxx is the go-to, the S&P actually was the market that most people would lean to first. The reason being, that's become the kind of default for trading tariffs. So everyone would look for S&P. The other advantage you have here is the S&P is starting to break out of a range. So the Apple tariffs, which is the initial drop, left-hand side, then takes you below 42, and that gives you the opportunity for a further break below 29, which is the most recent low, and then down to 05, and then beyond there, down towards 69, much, much lower down. So this is a market that's ready to go. It's already sort of broken out of the wider channel on your hourly. It's ready to drop. The news is there to just give you that push over the edge. So a lot of the emphasis then goes towards S&P. Technically, it looks good. It's also the general go-to on tariffs. What it does feel that we're getting towards, and when we talk about sort of lessons to be taken from this, is equities are now just your go-to for tariffs. I've always said this about equity markets. They at least have a cleaner element to them. Bad news is bad, i.e. bad news is sell, good news is good news is a buy, on the whole for equities, particularly with any kind of uncertainty. We're seeing some differences now with other markets, which is what we'll kind of come to in a moment. But beyond the S&P, the more directly impacted was the Eurostoxx. Again, technically, Eurostoxx really, really nice. This had not broken out of its channel, so actually was in a better place for a sell for the break of 88, 55, 32, and then close the gap down at 04. Real key, look at your hourlies, work out where your targets are. So if you've hit this, you can then effectively just tick the targets off as we go down. I'll show you the ladders in a moment, and we'll be able to see how we move through each of those targets. But what was particularly interesting here is the gold reaction. Gold was slow to react. So if you did take your time to interpret this information, gold was perhaps the place to be because you had the chance to work it out. The problem with gold here, though, is the influence of other markets, the correlation to other markets. Gold theoretically should go up on the basis that this is bad news, so people look for safety and buy gold. However, when you flick it over to the euro chart, the euro dropping is a dollar strength move. If dollar strengthens, gold effectively becomes more expensive and therefore sells off. So now you've got this conflict between gold dropping on the basis of dollar strength, but also gold rallying on the basis of bad news and safety. That's arguably why it took that little bit longer to really start to get going. The other thing to look at is the euro. Now, the go-to scenario for currencies this year has been tariffs, sell dollar. So to sell dollar when you're trading euro dollar, you buy euro dollar. So euro up, dollar down. And on the Apple news, exactly what happens. But when you obviously have a European directed tariff, you can't justify buying the euro. Therefore, you get this kind of flick up on the it's a tariff buy euro idea, followed then by this drop on the it's a tariff on Europe type of trade. So again, that go-to sort of immediate tariff buy euro idea diminishes. And actually, for obvious reasons, this is then a sell in the euro. So what the lesson to be taken here is markets are not reacting on the whole in ways that you would entirely expect. Even if you take tariffs that we saw later on and Trump's suggestion about China tariffs, we saw bonds rally and then roll back. And we won't get into it today on the idea around stagflation and the impact on bonds. But there is also a sort of less than clean move in bonds as well. Let's go and have a look though at the ladders, because that's the bit that you really get the sort of learning from of how these types of things play out. We're going to particularly focus on the S&P and Eurostoxx for this. So here we go. The main two markets then that you're watching out for are the two on the left hand side. That's the S&P and that's Eurostoxx. Now, as I said, when that news hits, the key level in the S&P is 29. I've talked about this in other videos as well. Need to know your sort of key supports, because on the break, that's where the move's going to really come from. So your key level in the S&P is 29, which is below where we're starting off. And for Eurostoxx is 88. So for each of them, you've got about 10 full points in the S&P. You've got about 20 ticks in Eurostoxx. That's where you need to get in. As long as you're above there, when you get short, you're in a good place. So let's go and have a little look at how this one plays out. So you'll see when the news hits, because you see this much quicker sort of whip down across markets. There goes the S&P down to 33. Eurostoxx, you've got time. It's not reached 88 yet. The S&P is already off the screen. So through 29, through 20, Eurostoxx is now through 88. So your target in Eurostoxx, straight away, you'll now think it should be 55 at a minimum. And then you can start placing your targets further down towards 32 and then 04. The S&P, if you remember, 05 is the place to be. This is also why you write your levels down at the beginning of the day. I don't want to be sitting here looking at charts as a move like this starts to play out. Now into gold as well. The euro's already moved too quickly. Treasuries, which is the middle ladder, have also moved. So you're now in a situation where you can focus on the S&P, you can focus on Eurostoxx, and it is just a case of ticking your levels off as this goes down. We also see on the ladder there a large order, that 900 on the Eurostoxx at 41. This is an opportunity to sell ahead of that, increase your position. Even if you're only going to get out at 32 and nick a few ticks, it's an extra 8-10 ticks that you're taking out. So it's in the S&P now starting to kind of stall as it's going down. Obviously, by this point, you will have read that this is a European tariff. And so your focus now really should be towards the Eurostoxx and trying to extract as much out of this as possible. With the S&P, you can wind your position down, because this is the one that's becoming a little bit more volatile, a little bit more whippy, where you're now seeing Eurostoxx starting to find resistance at 55. That was the key level. We're holding below there. As long as you stay below 55, we're all good. Finally, gold has now started to move. And we got into gold down at 33.27. Gold's now around about 100 ticks up. It's approaching the top of the recent range. This is where what you're doing here, and this is a technique that a lot of people use to try and maintain position. You think about how far on side you are in, say, the S&P. You're perhaps 40 handles on side in the S&P. You're now 50, 60 ticks on side in Eurostoxx. You can afford to let gold sort of wash around here, because you've got the P&L to back that up. If gold rolls over and you end up getting nothing out of it, you've still had a very, very good day in the other two. So you put yourself in a position now where you can give gold that chance. Give it the chance to be able to move. Yes, it rolls back on you, but your focus then goes towards Eurostoxx, goes towards S&P, and this in itself allows you to kind of weather the storm in gold. So now it really is just a case of managing where your stop is. So in Eurostoxx, you're thinking, right, as long as it stays below 55, we're all good. The fact that you're through 32 here as well should give you added confidence. We shouldn't really be coming back much above 32 and looking now all the way down towards 05, 6, 7 area, which is that fill of the gap, which is the next final place that you're looking towards getting to. Always the case after any kind of news. And this is something that people struggle with sometimes. You see how everything's now slowed down. We've got this sort of stability, or to a degree. This is where, if you've got the contextual awareness, the sort of longer time frame charts and you've worked out where this can reach, you don't end up getting spooked out. Where people can end up getting spooked out is they're now, let's say, looking at Eurostoxx and seeing 25 ticks off the low. And you're thinking, oh no, I'm losing effectively. I was 25 ticks better off. Yes, but think about the scope of the move. And this is where you can really get paid on these, by being able to get in and then holding the position as you continue down. Yes, scale out. Absolutely. Take something out of 55 at 32, but make sure you run something for the big target. And that's where you really get paid, because those extra 30 ticks through the low are, obviously worth a lot here. Don't go getting out just because this ticks back and you think, oh no, I'm losing out. If you chase it back up, what you actually end up doing is losing out by virtue of giving up the rest of it. If you got out at 40 in Eurostoxx here and it does another 40 ticks, you've missed that. Rather than look at it and say, well, my target's down at 07. Let's see if I can get there. In the long run, this will pay you. It's the short run that feels very, very uncomfortable. But you get a few of these that work, it reinforces the idea. You stick to these types of trades. So now starting to see the Eurostoxx run through what was the low at 20, you're now looking for the accelerated move towards the downside. If you've got a clear level, like that gap fill down at 07, 05 area, this is where you are going to be a little bit quicker to get out. If you've still got something left, if this doesn't go straight down now, this is where you do then start to wind the position down. So you get another bid in, it starts to tick off the low. This is where you start thinking, okay, it's no longer going. Get yourself out, take what else you can get left. Yes, you're chasing up a little bit, but you've just found out that this doesn't seem to want to go through that gap. And that's where you can then get out of it.